Welcome, attendees. The American stock market is on the brink of collapse. There's only one thing that can save them. I want to talk today about that solution: market flow. You know, the dynamics of price, and not just superficial movements, but the mechanics of capital itself. So let's start with the basics. Every price is a laminar construct until it isn't. Laminar, meaning smooth and unidirectional. Here is those prices. Predictable until now. In a very limited sense, we could see what was coming. The moment turbulence would appear, which is almost immediately, we're in what engineers would call the critical regime. That's where chaos starts to dominate. The Reynolds number on any order book starts to exceed the threshold of rational observation. And if you imagine the bid ask spread as a pipe, then retail investors are boundary layers. They move slowly, they're viscous. Institutional traders are free steam. They move faster with less drag. And the interaction between these layers generates vortices, small whirlpools of liquidity that suck in smaller orders. And those are called eddies. So we have velocity and we have viscosity. And ideally, we want more velocity and less viscosity, but not reckless velocity, more controlled. The trick is to reduce the coefficient of hesitation. We call it the V, vega, in fluid dynamics. In markets, that's fear or uncertainty. If we consider the Napier-Stokes equation, don't worry, I won't go into full detail, but it's where P is price and pi is the narrative pressure. The vega, as I said, that hesitation, retail hesitation, institutional, professional hesitation, that's negligible. Every surge in price is a cavitation bubble. And when local pressure drops, hope bubbles form and then implode, eroding confidence. Then turbulence propagates like Kormorgov cascades from large market waves to smaller eddies until the energy dissipates in those transaction costs. And if you think then about liquidity as a superfluid, which is the ultimate goal, we need absolute zero doubt. Zero doubt is when traders are indistinguishable, coherent, and flowing together like quantum coherence. Unfortunately, we never cooled a market that low. Now, every market has these boundary layers, thin films between conviction and capitulation. Traders near the wall shear stress of uncertainty. They move slowly, almost stationary. And the outer stream of overconfidence that flows faster and exponentially returns. Friction factors matter. The Moody chart applies metaphorically. Roughness increases drag, retail forms increase roughness. Institutional silence reduces roughness, but fear is still the primary coefficient, always. The laminar losses then accumulate silently, like head loss in a long, straight pipe. By the time turbulence emerges, your capital reservoir is partially drained. critical Reynolds numbers mark the point of sudden acceleration into chaos. Cavitation again when pressure drops below the pressure barrier of vapor optimism. Bubbles start to form, implode, and then leave scars. Vorticity, then, the curl of order flow, that pulls in the smaller traders into those whirlpools they didn't anticipate, like leaves in a drain. Turbulence follows a cascade. Yes, that Kolmogorov cascade. Energy transferring from the macro market waves to micro fluctuations, dissipating in those transaction costs, which are emotional heat, fear, greed, and regret. Promotional cycles and that head loss can be seen like influencers bending the flow, each bend consuming some of that pressure, leaving only a trickle downstream. And Bernoulli, yes, Bernoulli, he tells us where velocity increases, pressure decreases. And in markets, the faster a stock rises, the thinner the air becomes until no one can breathe at altitude, until the sudden stoppages causes that hydraulic hammer. Sudden hard stoppages cause that market hammer, reverberations down every pipe, rupturing leverage, fracturing the system. Strocal numbers describe oscillations in flow. Similarly, rumor and rebuttal create these vortices, shredding off the main current. Freud numbers govern wave behavior. Subcritical flows allow news to travel upstream. Supercritical flows carry prices so fast that the narrative can't catch up. Mach numbers too. When velocity approaches the speed of sound, the spreads tighten, the shock waves propagate, and faces are metaphorically lost. Prandtl gave us these boundary layers, but markets bring paradoxes. The more liquidity, it seems, the more illiquid it is, that same market under stress. So we look to Darcy's friction law, and it shows us that length increases loss. In finance, the longer you hold, the greater the friction. That leads to this viscosity. So kinematic viscosity turns into momentum diffusion, and that leads to depression in prices. It's a regret diffusion. Past trades tempt future trades. This rolls into your future portfolio and leaves traders swimming in their own inertia. The dimensionless numbers of fear and greed always end up trading down and trending to one. Unity between the two, clearly critical. And in every bend in the system, every entry becomes irreversible, as the second law applies of thermodynamics. Entropy increases with every trade. Markets jump hydraulically. Abrupt transitions from supercritical to subcritical states dissipates that energy violently. Super speculation occurs and delivers absolute zero doubt, and no one has ever seen a market cooled that low. But every bend in the system, just every turn in that pipe, leads to capital flow resistance, turning high pressure to low, and energy is lost on every curve. Every network terminates in the CERM reservoir at zero. So you want more viscosity if you want less velocity, but more velocity with more pressure. But that pressure leads to fissures unless you control the dynamics. Every price a laminar construct until the turbulence emerges, unidirectional, predictable in that limited sense. The bid-ask spread a pipe, velocity and viscosity balanced. The Navier-Stokes equation governs the flow. Price surges from forming these cavitation bubbles that can lead to scarring, liquidity, ideally a superfluid markets, creating those boundary layers, and friction factors matter. You understand the vorticity of order flow, how smaller traders are sucked into the whirlpools, how the promotional cycles add to the headwind, and how sudden stoppages can be like that hydraulic hammer. So you understand how the markets together deliver that Prandtl paradox. The more liquid a stock appears, the more illiquid it becomes under stress. How Darcy's friction law applies, and the kinematic viscosity diffusing that pressure on price. If your entry is irreversible, then the system flows in one direction, though it still undergoes phase transitions. And in those areas, there's a solid conviction melting into speculation that vaporizes into froth. The latent heat actually surges because it's supplied by leverage at that moment, and there is no boiling point, only tepid oscillations in overbought. The vicious dampening comes in, reducing volatility, and market makers act as those dash pots, absorbing all that amplitude. The excessive dampening from their interaction with the dynamics creates this stagnation, and a chart can appear lifeless right at its peak. The collective action subsequently creates intense turbulence, and the stresses appear in community forums. Those correlations amplify beyond comprehension. The price diffusion is stochastic. Doubt diffuses faster than the price. A single uncertainty molecule here can contaminate the entire system and will spread isotropically. The Pleckett number describes advection versus diffusion. And in equities, there's a very strong narrative of advection dominating the informational diffusion. The high plectic number means that stories dominate. Low plectic would allow for truth to catch up, but traders prefer that high plectic environment. So flow separation starts to occur. This is particularly important. That angle of attack exceeds a critical value, and sentiment then detaches from the fundamentals. And here you can see an even clearer example of that reality. The market vortex is tensorial. Speculation rotates in multiple dimensions: price, volume, time, rumor. Traders perceive these as projections, while hedge funds perceive the tensor itself, which is why they usually win. Non-Newtonian markets clearly exist. Crypto is sheer thickening. The more force that's applied, the more resistance it meets. Blue chips are more sheer thinning. Liquidity improves under stress. Meme coins, they're isotropic gels that liquefy under attention but solidify when neglected. And this is the dynamic, the balance you must find between velocity and viscosity. We're at now the phase transition in the market itself. Ubiquitous conviction solidifies and melts repeatedly. This creates clear stress. Depending on the leverage, the rumor, and the narrative pressure, that latent energy stored in positions could be released explosively. And when thresholds are exceeded, producing waves that propagate unpredictably through the network of traders, you can expect oscillatory dynamics to emerge. The Struhl numbers dictate the frequency of those recurring cycles, the short-term oscillations interacting with the long-term cycles. And this produces resonances in price action, and in all of those dimensions, traders caught in that resonance amplify the volatility unintentionally. So market microstructure exhibits this turbulence at multiple scales simultaneously. Small eddies arise from algorithmic trading. Medium eddies arise from institutional allocation shifts. Large eddies forms sector-wide narrative shifts, and energy cascades downward until it dissipates in those transaction costs, slippage, and psychological fatigue abound. The cavitation events are critical, small at first, but coalesce into bubbles of irrational exuberance. The implosion of these bubbles leaves scars in portfolios and narratives. As an observer, it's very easy to confuse the collapse with randomness, when in fact it's the inevitable dissipation of that latent market energy, and we can calculate it going back to those boundary layers of the sentiment which created the zones of low mobility. Traders in those layers are effectively trapped and moving slowly with high friction. Overconfidence occupies the free steam, moving at exponential velocity relative to the boundary layers. An interaction between those layers produces that shear and vorticity, often unnoticed, until the downstream effect is catastrophic. So the friction factor, that which is modulated by both internal and external conditions, retail forums, social media, and speculative narratives, which increase that surface roughness, increase that drag, that institutional silence, itself reducing roughness and allowing smoother flow until the coefficient of fear dominates the variable. The viscous losses, they accumulate when sudden cessation of flow reverberating throughout a network. And that creates these herd motions, these stop loss triggers and mass exits that produce and amplify further analogous shockwaves. This fracture, this rupturing of fragile positions is natural. The market responds similarly to pressurized conduits. Pipes rupture, energy dissipates violently, and downstream participants are engulfed in turbulence. The principle we'll use is Bernoulli's, and we'll not go into it again in too much detail, but it analyzes that velocity and the narrative pressure. As the velocity of price movement increases, the perceived pressure decreases. Rapidly rising assets then become thinly supported. This creates an altitude stress on investors and liquidity providers. It's counterintuitive, but spreads compress until structural collapse becomes possible, at which point they collapse immediately. And this is how the paradox persists. Higher apparent liquidity leads to decreased functional liquidity under stress. The law we touched on was Darcy's. It governs that temporal friction. The longer the position held, the greater the viscous dissipation of the capital. Time acts as viscosity. The kinematic viscosity of regret will spread through future trades, and this contaminates the future decision making. So dimension ratios using fear over greed will always tend to unity, which means that unity indicates criticality. And at criticality, small perturbations propagate freely, and that produces disproportionate effects. Market entropy is strictly increasing, which aligns with the second law, and every entry being irreversible means that every decision diffuses entropy throughout the entire system, which creates these hydraulic jumps, which are natural, and it's part of the abrupt transition, this phase transition from supercritical to subcritical, and that produces the energy dissipation. In markets, panic and euphoria act as analogous to these hydraulic pumps. Market entropy, strictly increasing, always amplifying. It's an absolute theoretical limit, that superfluid speculation, and it requires zero doubt. It's perhaps unattainable, but conceptually useful because it proves how that flow separation occurs when sentiment exceeds the fundamental support. Detached sentiment forms wake regions, turbulent zones where rational analysis fails, and then strain rates of traders increase significantly. Elastic traders can rebound, but plastic traders melt and deform permanently, they themselves becoming that viscoplastic response. They can't yield under pressure, they don't understand how to adapt to conditions. The vorticity itself, tensorial speculation, needs to rotate in that multi-dimensional space of price, volume, time, and rumor, and projection of these onto the market will yield partial but misleading and misunderstanding. Non-Newtonian characteristics will dominate. They need to be built in. Think shear thickening and shear thinning. Phase coherence will emerge, but only after traders learn how to act collectively, analogous to quantum synchronization or that beauty pageant. True coherence is unattainable at human scales across these large groups, but pseudo coherence can create the illusion of market fluidity, and observed coherence could persist, if only briefly, before collapsing under stochastic perturbation. So you have to be ready, because the information will diffuse along a stochastic but partial differential equation. Doubt will propagate faster and price itself will drop. Single units of uncertainty will contaminate isotropically, and it will produce these widespread oscillatory reactions. So we're looking for a high Pliket regime which would favor a narrative-driven motion and allow fundamental convergence. Shock waves will propagate, especially in this compressible market. The Mach numbers will approach unity during extremely velocity-driven events. Spreads will compress, liquidity will thin, and structural in collapse will become imminent. The turbulence intensity should increase both as a function of velocity and viscosity in terms of modulation. That viscous dampening, applied naturally by market makers, comes with frictional cost, and excessive dampening results in stagnation. Insufficient dampening amplifies the oscillations and creates a feedback mechanism that reverberates until systematic collapse. So optimal dampening is asotropically unreachable, but serves as the conceptual ideal. That is to say, that every system will ultimately thrash itself to death, but capital can flow through a network analogy to energy through pipes, energy dissipated at every bend, every junction, every constriction. There will be terminal points, reservoirs of zero potential, and they collect that dissipated energy. Despite the complex topology, every system ultimately obeys the conservation laws and follows the entropy constraints. So as you can see, the stock market has approached that climactic point. Markets are multi-phase systems, solid conviction, liquid speculation, vaporized hype, each phase interacting, exchanging latent energy. Those phase changes, often triggered by leverage, rumor, and systematic perturbations. Latent energy accumulating, invisible until it's released, and then unignorable, producing waves that cascade, and a network of traders amplify it across the world. Those oscillatory dynamics dominate in the global system. The Struhl numbers dictate the frequency of that cycle. Short-term fluctuations resonating with the long-term cycles, all of this built in with extra friction factors. So that viscous dampening It's the genius of market mechanics. It's simultaneously observable and inscrutable. The laminar is smooth until turbulent, the viscous dampening perfect until that superfluid yet predictable explosion leaves chaos in every wave, every eddy, and every vortex. That itself becomes an expression of velocity modulated by the previously abandoned viscosity, and capital becomes modulated by fear and greed again. So remember, more velocity, less viscosity.